in Kenya, with inflation at 5.27%, a rate cut was expected by some analysts, but not by others, especially with the possibility of a Fed rate hike coming in June. But with the food and index rising by 1.5% on a monthly basis and elections due in just over a year, was this cut expected? Well, CCTV's Ramah Nyang earlier sat with Stratlink Africa's Julians Amboko to find out more.
We had seen inflation coming back within the target corridor, and the shilling had become quite stable, and therefore we foresaw that the central bank was likely to slash the rate. And looking essentially from at the stock market, which gives an indication of the state of the economy, we saw it as a necessity that the central bank would now move to try and catalyze investment activity. And therefore we were really anticipating this. Yes.
But was this the magnitude you expected, 100 basis points? Or did you expect a slightly slower series of cuts?
Actually, we had given a forecast for gradualism, expecting about 50 bips. So when it did by a margin of 100, we actually thought, wow, then the central bank is really looking at the performance of the private sector a lot more seriously than we thought about it. And then there's been talk about the Federal Reserve in June hiking rates. So we thought there would have been a lot of caution, but it seems like the central bank is confident about
Wouldn't it be fair to read this in two ways? On one hand, there's the concern about the output gap, which the governor did raise today, and therefore we need to provide a bit of a supportive cushion, so to speak, to the private sector. But could also this be read in the context of what the Fed is doing, or is likely to do in June, which is raising rates, in effect bolstering the dollar, and that might give a hit to emerging markets and frontier currencies like ours?
I think the focus is more on the domestic environment. I think there's been a lot of news around the stock exchange and what it actually means, because it's one thing to look at data from the Kenya National Bureau of Statistics. It's another one for a metric like the NSE 20 to actually tell you what exactly is the kind of pulse that is being felt in the domestic environment. So from our assessment and from the numbers we're looking at, we feel that there's a lot of concern about the private sector activity and how it has been trending over the last 6 months. So the necessity was for it to intervene and try and support the private sector.
What are the main bottlenecks we're facing in the private sector?
Last year was a tough year. And businesses don't just claw back lost ground just like that. It takes a while before you cover on the losses you made in that particular year. So trying to give it a sense of stability in terms of 2016 is where the focus is.
But isn't this, for lack of a better word, isn't this just a bandage? Because usually, historically, before an election, the year preceding that doesn't do necessarily that well, with the exception, of course, of, say, 2007. Very strong growth there. After that, we're back into the dishes. Isn't that likely to happen now?
Well, looking at it from a political risk perspective, and the developments around the protests we've been seeing would actually raise a lot of concern. But we don't think that this particular decision was informed by that perspective. We've been looking at a number of metrics. We've been looking at the food index. We've been looking at money supply. And we actually think that the decline in inflation was more of money supply, crunching the money supply perspective, than the food side of it.
Speaking of food, we've been having some decent rains, or rather excessive rains, depending on how you look at it, for the last couple of months. But moving forward, is this likely to have a negative effect on food inflation?
It depends. It depends on the kind of rains that are sustained going forward. We have seen the meteorological department has been announcing that it's going to be a bit mitigated going forward, which I think will be of help, because if, again, it becomes in excess, then it would have a detrimental effect as far as inflation goes. But we have seen it moderating in the recent past, and we are confident that it will be maintained as such. So we do expect inflation to remain just trending within 5–6% in the next quarter.